Yeah, welcome to Dr. B.R. Ambedkar Open University students to this financial management course. Now, we are going to discuss on the important aspect which is related to Unit 7, sources of finance. Now, any firm, it may be a sole trader, it may be a partnership or it may be a joint stock company. Now, if you want to start a business, now every firm or the company requires the amount of money which is called the financial resources. Now, the financial resources are required for the purpose of investment. Now, the companies what they will do is that they are going to select a particular product or project for the purpose of production, or you can go by rendering of services by the service rendering institutions. Now, for that, now they will go with the feasibility study and where they are going to invest and how much money which is required for that particular project. Now, for the after the estimation of the amount of money or the finance required to start a business or to start a particular manufacturing process or to render a particular service. Now, or the companies are already existing. Now, the companies may also require the further or additional capital for the purpose of investment in the additional or the various other instrument or investments. Now, for the purpose of this, now we must try to find out the availability of the resources, especially the financial resources. So, from where the company must mobilize the financial resources. Now, this unit is mainly focused on the sources of financial resources. So, how best the finance manager is going to mobilize the financial resources? Now, that must be here we have to discuss now. Now, here we have to focus on this financial management according to your syllabus is going to deal about the business finance. Business finance is also called a corporate finance. Now, there are the other terms like public finance, personal finance, business or corporate finance. Now, we are going to cover only the business finance here. Now, the personal finance is related to the finances of a family, and the public finance is related to the finances of a state government, finances of a central government or finances of a municipal corporation like. But we are not going to cover these organizations here. Here we have to focus mainly on the corporate finance requirements. So, how companies are going to mobilize their amount of financial requirements, how they satisfy. Now, for the purpose of this, now there are three important sources for the purpose of mobilization of the funds. Now, the funds will be mobilized by the companies now according to their requirements in the form of the time horizon. For example, the time horizon is 1 year, the time horizon is 3 years, or time may be more than 5 years like. So, the funds will be mobilized today and these funds will be paid back to the suppliers. Now, after 1 year or within the 1 year, we will call it as the funds which are mobilized through short term sources. Now, companies may also aim to mobilize the funds for 2 to 5 years. Now, within these 2 to 5 years, they will pay back to the financial institutions or maybe whoever may be lending the money to the company. Now, the companies may also require the money for the purpose of long term requirements. So, generally why companies require the money for the long term requirements? So, the long term requirements are investment in the fixed assets. Now, investment in the fixed assets is called capital budgeting. Now, investment in the form of purchase of machinery. Now, it may be in the form of construction of a factory building, office building. Now, purchase of the automobiles which are required to this particular company for the purpose of transportation and all other requirements. So, anyhow, for the purpose of this, the amount of return is going to be received within a long period of time. That is why the longer the justification period, now the companies are also going to mobilize the funds from the long term sources. So, there must be a match. For example, you can consider working capital requirements. So, working capital requirements are the requirements for the 1 year or very short period. For the working capital requirements, they can go by the different instruments. For the capital budgeting requirements, they will also go with the various other instruments. Now, we are going to discuss each and every source of finance in detail by considering the different types of instruments which are comes under in the long term, short term, medium term like. Now, we have to focus on the long term sources of finance. So, generally the companies requires for the purpose of investment in the capital budgeting or fixed assets. Now, this is the requirement which is very much satisfied with the help of issuing the different types of securities which are in the long term in nature. Now, for example, you can take the long term sources of finance is one important instrument is that issue of equity shares. So, what the companies will do? Companies will issue the equity shares now for the purpose of investment. Now, equity shareholders are going to become the owners of the company. Now, how the equity shares are issued? If it is a new company, the new companies will issue in the form of IPOs, initial public offers. Now, if the existing companies are also there and they want to invest in the form of expansion or in the form of renovation, innovation. Now, there are new technologies they want to purchase. Now, they require the additional amount of capital. For the purpose of that, they will go with the further further issue of the equity shares to the different public. Now, the equity shares, important features of the equity shares are equity shareholders will get a dividend, but the getting of dividend from the company is not mandatory, but generally what the companies will do is that if they want to retain the equity shareholders in the long run, and companies will also announce the dividend every year. So, dividend is the return to the equity shareholders, that is a regular return, and in the other form also. Now, if the share price is increasing in the market, now those who are already invested in the company in the form of an equity shares. Now, for example, at the time of the purchase it may be at 200 rupees. Now, after 1 year it may be 300 or 400 rupees. Now, that whatever the difference is, that difference is called capital appreciation. So, investors may get in the form of capital appreciation, now may also get in the form of a dividend. These are the two important returns will be now that is get by the investors in the company. So, company is also having a responsibility to utilize this particular money for the particular purpose, and the companies will also inform the prospective investors at the time of the IPO. So, why this amount is going to be they are mobilizing and where they are going to invest this amount of money. So, after the reading the red herring prospectus or the prospectus by the prospective investors, if they satisfy with the whatever the information supplied by the company, now according to that they will get the applications from the prospective investors. So, based on that, now they will finalize the process and this money will be utilized for the purpose of fixed assets. Now, not only that, now we will also have another important product, financial product or the instrument which we call it as preference shares. Now, preference shares also issued by the companies. Now, but there is a difference between the preference share capital and the equity share capital, or preference shares and equity shares. Now, in the case of preference shares, they will get the dividend regularly. Now, the rate of dividend is also mentioned by the company at the time of the issue. For example, if you see the prospectus of the company, when they want to mobilize in the form of preference shares, they will specify that 10% preference shares or 15% preference shares. This 10% or 15% prefix is called the rate of dividend, which is given to the preference shareholders every year by the company. Now, these shareholders are not having any voting rights. Now, preference shareholders are not the owners of the company, but equity shareholders are having the rights for voting, and preference shareholder equity shareholders are having the rights, and equity shareholders is also they are also participating in the different meetings like. Now, they are the owners of the company, but preference shareholders are not the owners of the company. They are having the preferential rights. The preferential rights which I have already shared with you, the first one is they are having the right to get the dividend regularly, that is preference dividend, and second point is that now at the time of liquidation of the company, they are going to get back their amount of capital before the equity shareholders. So, that is why these are the two important preferential rights which are there to the preference shareholders. So, that is why if company wants to mobilize the funds in the form of preference shares, now they will issue the preference shares to the public. So, there are different types of preference shares. Now, the preference shares may be converted after some time, it may be redeemed after some time, or they will also participate in the profits after the getting the dividend also. That is why we will call it as participating type of preference shares, convertible preference shares. Now, the preference shares may be redeemed or preference shares may be irredeemable. So, these are the different categories are there in the preference shares. Anyhow, there is a demarcation between preference shares and equity shares. So, preference shareholders are not the owners, but equity shareholders are the owners of the company. Now, another important instrument which we have to discuss now under the long term sources of financing, which is debentures and bonds. Now, debentures or bonds are the debt instruments. So, these debt instruments also issued by the company. Now, companies will issue equity instruments, preferential instruments and debt instruments also. So, in the case of this debt issue, now the debt issue is nothing but in the form of a debenture or in the form of a bond. The difference is very slight. Now, debenture holders are the unsecured instrument, bond is a secured instrument. So, that is only a small difference, but these two are the debt instruments issued by the companies for the purpose of mobilization of the funds in the form of a debt. So, in the what are the advantages, why companies will go to a debt instrument? Because when a company issued the debt instrument, they will have the advantage of the corporate tax. That corporate tax advantage they want to take up, they will also go with the debentures or the bonds. So, this debenture or bond is also a long term instrument. So, these are the three important instruments which are comes under the long term sources. Now, the other important source which is the short term sources of finance. Generally, the short term sources are the sources which requires for the period of 1 year. So, within the 1 year they will pay back. Now, the short term securities are, for example, the suppliers credit. Now, not only that, the trade credit. Now, these are the different forms or issue of the marketable securities. Now, the marketable securities life is very short. So, whenever you want money for the short term requirements, now you can also issue, and whenever it is not required, you can also pay back. and not only that, the short term loans which are taken from the financial institutions. Now, that is also possible in the case of the short term sources of financing. Now, short term sources of financing, there are certain institutions which we have already discussed, that the financial institutions are going to offer. Now, the Industrial Finance Corporation of India, Industrial Credit and Investment Corporation of India, like this, there are certain institutions at the state level, institutions at the central level. These institutions are also sponsored. Now, for example, NABARD is there. NABARD will sponsor certain amount of loans to about agri-business companies like. Now, NABARD is also sponsored to some commercial banks like. So, anyhow, the financial institutions are there. Every financial institution is having its own objective. Now, according to that, they will also sanction the amount of loans to the financial requirements of the firms for the short period of time. Now, we will also have the other important source of financing is hybrid finance. Now, hybrid finance is nothing but the combination of equity and debt. Now, an instrument which is developed or an instrument which is having the characteristic features of debt and some of the important characteristic features of the equity. Now, for example, you can take a lease financing, warrants. Now, not only that, the preferred stock. Now, you can also try to consider if it is a convertible in nature. Now, for the period of first 5 years, for example, they may be going with a debt instrument, right. After the 5th year, the debt is converted into an equity. Now, if the convertible debentures are there, now the convertible debenture is the debenture which is converted into equity after the specified period of time. So, like this, now we have a combination of debt as well as a combination of equity, now which is called the hybrid finance or the blending finance. So, the blending finance is also playing an important role here. Now, with the help of this, now we have also another important aspects, medium term requirements. These medium term requirements also companies will satisfy in the form of issuing the different debt instruments. Now, for example, a period which is may be required for 2 to 5 years. Now, for example, longer the period means more than 5 years. So, 2 to 5 years requirements, they will design the special instruments. With these special instruments also, now they will get the amount of money. Now, for example, you can also consider today we are talking about startups. So, startups also requires money. So, from where these startups will mobilize the financial resources? Generally, startups will mobilize initially those who are starting the business. Now, they will also contribute, but their contribution is not satisfy the requirements of the business. So, what they will do? They will also approach the venture capitalists, the private equity. Now, not only that, now some of the investors which are there in the market, now they will also contribute the amount of the finance, but only thing is that the promoter is going to satisfy. So, convince the promoters, those who are going to invest in the company. So, like that, it may be a startup company, it may be a company which is already started, which may be already matured. Now, it may be a big business house like an MNC. So, multinational companies will also mobilize the funds from not only a domestic country, they will also mobilize the funds from outside the country. Now, outside the country in the form of what? In the form of issuing shares at the global market. International market also they will issue the shares, and not only that, they will also go with in the form of ADRs, GDRs like. So, American depository receipts, these are the instruments issued in the America, and they will mobilize the funds outside the players. Now, not only that, GDRs also there. Now, the global depository receipts. So, global deposit receipts are issued outside the America. Now, not only that, the multinational companies are having the uh, advantage of mobilization of funds now in the Euro market, in the American market. Now, not only that, in each and every market, wherever the possibility is there, they will also go there and they will mobilize the funds. Now, not only that, at the time in the case of the sources of financing, what factors are going to influence the company to go for a particular source of financing. Now, most of the cases what you will do is that what is the cost. So, how much interest they are charging or at what interest rate you can issue. Now, not only that, if it is a equity form, so to what extent we have to declare as a dividend. Now, based on this, if it is a debt, now cost interest is cost of debt. Now, if it is equity, the dividend is a cost of equity. Now, if it is a preference, the preference dividend is the cost for this preference. Now, based on that, the important aspect which will influence is the cost. Now, not only that, we must try to link this source of financing with the investment. For example, if you want to invest in a project, your expected rate of return is now 15%. Now, your cost must be how much? For example, 100 crores project is there. Now, 100 crore project, its return is expected 15%. Now, this 100 crore is required to mobilize by the company. How this 100 crores will be mobilized by the company? The companies will mobilize 100 crores in the form of equity as well as debt. Now, at the time of mobilization, they will also try to know how much cost is going to be incurred in the mobilization of equity and mobilization of the debt. On the whole, what is the weighted cost, that is also important. If the cost is 10%, your return is 15%, now you can go very easily, you can mobilize the funds and invest in the particular project. So, you will have an advantage over the cost, but your returns we are expecting 10%, but the cost you are going to incur in the mobilization of the funds. Now, here is it is more than 10% cost. Now, if this is the case, what you will do? Now, we are not going to mobilize and invest, because this project is not offering any return. If the projects which are not offering any returns, we are not going to invest in those projects, and the projects will be rejected. So, projects will be rejected means now we are not going to mobilize the funds for the investment. So, projects must be profitable in nature. If profitable projects are there, now we will invest in these projects. So, ultimately we have to go for the summing up of this lesson on the sources of financing. So, ultimately finance is the lifeblood of the business. Every business requires money. Now, it may be a sole trader, it may be a partnership firm, it may be a company, but the thing is from where you have to mobilize the amount of money which is going to play an important role. So, not only that, the availability of the funds and possibility of the funds which are also going to play an important role. Now, before 1991, it is very difficult to get the loans from the financial institutions because of the rigid policies of the government. But after the 1991 policy, industrial policy, now everything is liberalized. Now, the funds are moving from one destination to the another destination very easily. So, funds are moving from where the returns are less to where the returns are more. For example, the amount of money which is invested by the US investors in Indian market or Japanese investors are investing in Indian market. Why they are investing in Indian market? They are investing in the Indian market because of they are going to get more returns by investing in India compared to investing in their respective nations or the countries. So, that is why now the investors are looking into the throughout the globe, where the returns are more or much higher. Now, they are moving their funds, or the funds are moving from one continent to the another continent. So, with this liberalized environment, now it is very important to see that now where the cheaper funds are available. So, as a promoter, as a finance manager of the company, so what we have to look into it? We have to look into how much cost which is going to incur if you raise in the form of a debt, in the form of a equity, in the form of preference, or you may be borrow from the banking companies for the long term purpose or short term purpose like. Now, for example, if the metro project which we are already experiencing, crores of rupees invested by the state central and the private player. So, from they borrowed the money, from the consortium of banks. Not only one bank is supplied in the form of a loan, the combination or the group of banks are also sponsor if it is a big project. So, whatever the big projects, it may be a government or may be a private players are going to take up, they are going to mobilize the funds from the consortium of banks, that is also important. So, these are the different ways now we have to mobilize. For example, if it is a sole trader, now the money which will be mobilized by his own money, or the money which may be from borrow from the relatives near and dear like. If it is a partnership firm, now the firms will mobilize the funds from the partners, but most of the cases we have to focus on the multinational companies. That is why the money which is mobilized by the companies in the form of equity, preference, debt, and the borrowings from the financial institutions. Thank you.